Hey everyone, welcome back to the channel. Today we're diving into a topic that can supercharge your journey to early retirement: real estate investments. If you ever dreamed of quitting your 9 to 5 early and living life on your own terms, you'll want to pay close attention. Now, I'll be walking you through three powerful types of real estate investments, breaking down the pros and cons of each, and explaining when during your financial independence journey you might want to consider them. I'm Vinny, and I retired from my technology career in my 40s so I could play sports, travel the world, spend more time with the family, and gain new experiences. And real estate was a significant contributor to making my dream a reality. Now, first, why real estate? What makes it such a game changer for early retirement? Well, real estate provides three critical benefits: predictable cash flow, long term appreciation, and tax advantages. Plus, it's one of the few investments where you can leverage other people's money, like a mortgage, to build wealth faster. Now, there are skeptics when it comes to real estate, and there will be people who claim that the stock market will, over the long term, outperform real estate. However, I do think that having real estate helps you with diversification from the stock market, hedging against inflation, and when you do it right, can definitely provide oomph to your returns that can far exceed the stock market returns. Now let's break down the three types of real estate investments that can help you achieve financial freedom faster. Now there are other types, but I'm going to focus on these three. 1. Buying and managing properties. 2. Investing in real estate syndications. And 3. Investing in REITs or real estate investment trusts. First up, buying and managing properties. This is what most people think of when they hear of real estate investing. It involves purchasing residential or commercial properties, renting them out, managing the day-to-day operations either yourself or through a property manager. Now, when done right, this can be great early in your accumulation phase in your FI journey, as you could multiply your initial investment over time. Now, I would focus here on growth and not cash flow. Very similar to early on, if you were investing in the stock market, you would invest in growth stocks and not dividend stocks or bonds, because over time, the growth is going to outperform significantly and you aren't worried about short-term market fluctuations. So as an example, say you find a new development in the outskirts of your city that's going to develop over the next few years. I would buy a single family home between around 1,400 to 2,000 square foot for a new construction where I could break even with the rent and I get my expenses, including the mortgage payment, just covered with the rent. With new construction, you aren't going to have maintenance costs, so it's easier to work the numbers. So let's say you buy a 1,500 square foot new construction house for $250,000. And you calculated that you would be breaking even between rent and, let's say, a 15-year mortgage at 6%. Your monthly payment, including insurance and property taxes for this kind of loan, will be less than $1,700 a month. So if you get $1,700 a month in rent, your initial $50,000 down payment is your only investment in this property with a $200,000 loan. Now, what happens to this in 12 years? Usually, these new properties will appreciate significantly in 12 years. Even taking conservative numbers, let's say that this is worth now $350,000 in 12 years. And because your mortgage is paying down the loan, your balance loan amount after 12 years is only $50,000. So if you were to sell this house for $350,000, you paid the remaining $50,000 loan and you paid, say, closing costs of 7% or $25,000, you will still get $275,000. Remember, your initial investment was just $50,000. So in 12 years, your money has grown to 275,000, which is 5.5 times your initial investment. Now, when you compare this return to the rule of 72, which says your money should double every 7.2 years if you get the average stock market return of 10%, that means your money will 4x in 14.4 years. But here, it did a 5.5x in just 12 years. Now, I used conservative numbers, but personally, I got 7.5x returns in the 12-year period that I invested in these kind of homes. Of course, the returns were higher for me because the interest rates were lower 12 years ago. But the rents were also lower. So the rents have increased over time. So you could account for that. Now, obviously, your net worth growth is incredible with this strategy. If you're able to buy, say, one of these investments every year for, say, 3 years, your 150,000 investment in this 3-year period can easily amount to $1 million in 12 to 15 years. Now, there is one big tax advantage that you may get in addition. If you or your spouse can qualify as a real estate professional. Now, this does not require a real estate license, but if you can prove that you materially contributed to the property management of these houses, like finding tenants, upkeep, maintenance, etc., the depreciation of the property can actually offset your W-2 income. Now, I would suggest you connect with a CPA who specializes in real estate to determine how you can qualify for these tax advantages, but that can be game-changing. Now, here are some of the cons, though, with this type of investment. Managing properties can be time-consuming and stressful. You might deal with late payments, property damage, or difficult tenants. There's also the risk of vacancy periods where you're not earning rental income, but you still have to cover the expenses, the mortgage. So you have to be on top of it. When your tenant calls about a toilet flush not working and you are preparing a deck for your presentation at work the next day, it can get quite frustrating. And of course, it's not liquid like the stock market. So you can't just sell within seconds on an app and have your proceeds the next day or so. Next, let's talk about real estate syndications. Now, these are private investment opportunities where you pool your money with other investors to purchase large properties, like apartment complexes or commercial buildings. Now, a syndicator or a sponsor manages the deal while you're a passive investor. Usually, the syndicators are called general partners, and you are a limited partner. The general partners are doing all the work and they take a percentage of equity in the property as sweat equity, which is typically around 20%. Now, you can participate in these deals only if you are an accredited investor. Now, you can look up the definition of what an accredited investor is, but typically you are accredited if your net worth is greater than $1 million. Now, with these syndications, you typically will receive between 6 and 8% of your investment annually as cash flow, which basically comes from the rent they're collecting minus the expenses, including the mortgage. Now, most apartment syndications will have an exit strategy of 3 to 5 years, where they basically try and increase the net operating income of the property by increasing rents and reducing expenses. And then they sell the property for about a 25% greater than the purchase price. Now, again, this is where leverage gives you outsized returns. So if the down payment was 25%, then a 25% increase in the sale price pretty much doubled the investment. Now, after closing costs and the syndication taking their 20%, you don't quite double your money at the sale, but you get anywhere from 50 to 70% returns on your equity at the point of sale. Now, this is on top of the 6 to 8% you were receiving annually for rent. Now, in most cases, you double your money in 5 years, which is again better than the stock market average of doubling your money every 7.2 years. Now, the minimum investment is usually 50K, but there are some other watchouts as well. It's really important to listen to the webinars where these syndicators are pitching their investment, and even more important to participate in the Q&A where you can ask specific questions about the risk. Now, most of my investments in this category gave me more returns than the stock market. But there have been a few that didn't pan out as well because the syndications took a variable interest rate loan, and we all know what happened in the last 2 to 3 years with interest rates. So they really couldn't deliver on the promised cash flow because the expenses, basically the mortgage payments, became a lot higher than what they projected. Now, all my syndication investments with a fixed interest rate loan have delivered better results than they even promised. So, some of the pros here are like it's completely passive. You don't have to worry about managing tenants or maintaining properties. Syndications often offer higher returns compared to traditional REITs because they target larger, more lucrative properties. And they also can come with tax benefits, similar to direct property ownership. But here, it's going to be tough for you to justify because the property is being managed by the syndicators. So the depreciation that you get, that can only be offsetting the other passive income in your that you have, not your W-2 income. But again, you should talk to your CPA about this. Now, there are downsides as well. Like the biggest downside, I think, is it's a high minimum investment required. Typically, you need 50,000. In some cases, they require a minimum of 75,000. There is also less liquidity compared to other investments. Your money is tied up for several years until the property is sold or refinanced. Now, because you have many investors, the syndicators are the ones that make the decision on when they would sell the property. So you have no say in that. So you need to trust the sponsor or the syndicators or general partners, as we call it, to manage the investment effectively. Okay, last but not the least, let's talk about REITs, real estate investment trusts. Now, these are companies that own, operate, or finance income-producing properties. By buying shares in a REIT, you can invest in real estate without the hassle of direct ownership. It's basically like buying an ETF. Now, the big advantage is liquidity. You can buy and sell shares of publicly traded REITs just like stocks. Now, REITs also provide diversification as they often invest in a variety of properties across different markets. And they're also accessible, like there's no high minimum investment requirement. Like usually you could just invest in for as little as $100. But there are cons as well. Like REITs are subject to stock market volatility, which means their value can fluctuate more than physical properties. They also offer fewer tax benefits compared to direct real estate ownership. Now, all the dividends that you receive in REITs, they are counted as earned income. So not even like long-term capital gains. They just counted as earned income. So, you would be paying the maximum income tax on those. Now, we went through the 3 types of real estate investments. Which one makes sense? I think they actually all have value, but at different times in your FIRE journey. Like buying and managing properties is ideal for the wealth accumulation phase of your FIRE journey. This is when you have a stable income and can afford to leverage finance for property purchases. But you will also be needing to put in the time because it's not really passive. So early on in the journey, say when you're at work, you may not have as much responsibilities where you have the time, or you have a spouse that's not working that can manage this, is the greatest time for you to invest in these properties. Syndications are best suited for the transition phase, like 2 or 3 years before you hit financial independence. to 2 or 3 years after. When you've already built up significant savings and you want to diversify your investments without taking on the headaches of active property management. Now, REITs are ideal for financial independence or retirement phase much later, though, when you want to have completely passive income and easy access to your money. You also may at that point want to simplify your portfolio. If you're doing legacy planning for your heirs, you don't want to keep it too complicated with all these different syndications. Then it's a great way to still have real estate in your portfolio and not having the headaches of active management or complexity. So, which type of real estate investment is right for you? It really depends on where you are in your financial independence journey and how much time, effort, and capital you're willing to invest. If you're in the wealth accumulation phase, buying and managing properties might be your best bet. In transition, syndications, and later in retirement, REITs. Regardless of which path you choose, real estate can be a powerful tool to fast track your journey to early retirement. Thanks for tuning in. I hope you found this breakdown helpful. If you did, please give this video a thumbs up, subscribe to the channel, and share it with anyone who's on the path to financial freedom. And don't forget to drop your questions or experiences with real estate investing in the comments below. Until next time, happy investing and savor your financial independence journey.